Welcome back to the Dividend Diplomats YouTube channel. Everyone, Lanny, Bert, the Dividend Diplomats. Our last video, Lanny published his March dividend stock watch list where he covered 3 dividend stocks he's going to be watching. This video, my stock watch list for the month of March. We're going to have Bert's 3 companies that he's going to be watching here in the coming month.
Bert wants his dividend stocks and he wants them now. Guys, if you haven't already, just smash that subscribe button. Give Bert and I a nice thumbs up. Stock market, buying dividend stocks. Bert's got 3 dividend stocks to buy right now. We may share one on this list. We love producing videos to show you what stocks we are watching, what's on our radar, to hopefully keep you informed and to show you what's undervalued in the marketplace.
In all seriousness, though, yeah, we only share one of our 3, but Lanny's 2 other ones were great as well. There are plenty of other great undervalued dividend stocks to buy. I like to put the list at 3, just to keep it simple, just have 3 to focus on. But,
Destroyed like a tiger.
Yeah. So, all right. But why are we here watching and buying undervalued dividend growth stocks? Because we are trying to boost up our passive income stream by buying dividend growth stocks, because we always believe that dividend income is the best and easiest source of passive income. And why is that, Lanny?
Guys, because you literally earn money, invest in dividend stocks, and it is a true passive investment because you don't have to move or lift a finger. The dividend income hits your account. Maybe you drip, maybe you take it, but guess what? These dividend stocks also increase their dividend. So your income stream should be growing in the future as well.
That's absolutely right. And no matter what's going on in the stock market, whether we're watching and monitoring what's happening with Ukraine and Russia, the price of oil as things continue to develop with those 2 countries, or we talk about inflation back home, what's the US doing with their interest rates. There are a lot of interesting things right now that are going on that are causing the market to have some great days and have some sudden flash sales on it. And that's why it's always important to do your research ahead of time and to know what stocks are you like at the current valuations, so that when their price continues to fall and it continues to slide on these flash sales, you don't have to think about it. You can just strike right then and there because you've already done your pre-screening research.
Exactly. So Bert, here we are. We're in the week of March 7th. What dividend stocks are you watching and looking to buy right now in March as well as this week?
Well, there were 3 companies that are really high on my list. All 3 of them are actually in my portfolio or my wife's portfolio, 2 of which we've been aggressively building positions in so far here in 2022 to start and even ending the last year. One of them was the legacy position that I'm starting to accumulate my position and grow it even more because their price is just looking so great right now. It's pretty hard to stay off of that list. So I'm excited to share these 3 companies with you. Share the 3 companies have popped up using the Dividend Diplomats dividend stock screener going into it. Lanny, you want to summarize the 3 metrics here quickly for everyone?
3 metrics. 1, the price to earnings ratio less than the S&P 500. 2, the dividend payout ratio less than 60%. The perfect ratio is 40 to 60%. 3, dividend growth rate. We want a company and we want to buy stocks and assets that have a history of not just growing their dividend, but at a high rate. And last, but not least, the dividend yield.
That's right, Lanny. Let them know right there. That's how we find the undervalued dividend growth stocks. Let them know. That's absolutely right. So, all right, you ready? Should we jump right in here to the 3? Let's start with the first one, Lanny.
Bert, jump in. I know you've been loving this stock lately, especially because they are producing in the glorious state of Ohio. They've been on your list. You've been buying this stock a lot lately, and it's hard not to, overlook the stock price and the price depreciation that this company has had lately.
That's exactly right. This company is Intel Corporation, INTC. Love it because, they're investing. They just announced that $20 billion state-of-the-art chip plant here in the great state of Ohio. That's not the only place they're making investments, too. They're making massive $20 billion investments in Arizona, too. What I like about them is obviously they're a legacy company. They dominate the chip sector. They're quickly working to pivot and grow with it and dominate future sectors as well. But the reason their price fell is obviously because they're dealing with a lot of major supply chain issues from the global supply chain. These investments are going to pay some dividends in years to come because they're taking that excuse right out. They're ripping the rug right out from underneath that, saying, fine, we're not going to rely on the global supply chain anymore. We're bringing it back to the US. We're taking control of it. That's what I like about them. They're still a revenue cow, cash cow. That's why they've just continued to pop up on my watch list.
The cash cow, baby. So guys, Intel trading just around $48 per share as of the close of the last week. Analysts are projecting an earnings of $3.54. So Bert, what does that first dividend stock metric look for one of your top companies as of late?
PE ratio is 13.57, which is well below the S&P 500, which is around 24 to 25x right now, Annie, on any given day.
You got it. Yep. It's about half of what the market is currently valued at.
Yep. And so moving to that second metric here, Intel just announced a 5% dividend increase last month there. So pretty solid for the company, right in line with their average growth, as you'll see as we move into that third metric in a little bit. But you divide that by the $3.54 forward earnings, that gives you a perfect payout ratio of 41% right there.
Kind of like it. Plenty of safety in the dividend. Throw in the toothpick, guys. Intel, because of the earnings and cash they have, again, fairly safe way to cover that dividend as well as future growth. Going into that third dividend stock metric, they are now demonstrating a nice, strong, track record of growing their dividend. They had a couple of years where they may have kept it the same. But we haven't seen a cut from Intel as of late. They've had a nice 5-year growth streak right now of about 6% on the dividend growth rate. So again, right at around the inflation, obviously 5% just below currently the all-time high inflation that we're dealing with in that 7 to 8% range. And I just heard the price per barrel of oil is actually hitting close to or over $135 per barrel. So 5% may not help us at the pump.
No, it won't, but it's in line with their average. So even with some of the headwinds that Intel's facing, they're still announcing that dividend increase in line with their history. Management must not be concerned about the long-term viability of the dividend, given their payout ratio and the future money that they're spending. Moving into that dividend yield here, that bonus metric, their yield is 3.03%. So to me, it's nuts that Intel's at 3% dividend yield right now at their current price. So it just shows how much it's fallen.
Exactly. What comes up must come down. Right now, Intel's down, which means it must go back up, maybe. But to summarize the metrics on Intel, they have a 13 PE ratio, less than 42% dividend payout ratio, history of growing their dividend at about an average rate of 6%, with the yield that is officially over 3%. Bert, no wonder they are on that list.
Yeah, moving into number 2 here. This is the one that Laney and I have in common. Leggett Platt, ticker symbol LEG. Dividend, aristocrat / dividend king. They're right on the cusp here. This company, I can't believe their price is well below $40 per share. It seems like Leggett Platt cannot catch a break in 2022.
Well, whether it's with the interest rates coming up here from good old Mr. Powell at the Fed, supply chain issues I'm sure they have been dealing with, a lot of headwinds. I mean, again, the pandemic before that. So if there's a company that has gone through a lot, like many others, Leg was just a great example of one of those companies. But, again, a great company, not to go so deep in, but you could start adding a couple shares here and there. And I think that's what, Bert, is that kind of what your plan has been?
Yeah, we already have a pretty large position in there. We already have about 145 shares of the company, 146 based on how we round the fractional share. So, adding 5 shares here, 5 shares there, 10 total, 15 slowly over time. It'd be great to continue building our position, especially now that they're trading at 37.30, which is where they ended this previous week. So jumping in here into the metrics, they're priced as of 3/4 close when we're recording this. 37.30 forward earnings was $2.82. That first metric's the price earnings ratio, 13.22x. So again, another company trading at a big discount to the S&P 500.
Pretty similar to Intel too, right at that 13 PE ratio. Going into that dividend payout ratio, again, we're talking the amount of dividends over that forward earnings per share. And Leggett & Platt's dividend is in that perfect sweet spot, just under 60% at, according to, and you'll have the link in the description to the article Bert also wrote on this exact same topic. The dividend payout ratio is about 59% for Leggett and Platt.
Yep. Enough. Perfect. Right there. I mean, hey, company that's struggling, I'd be much more concerned if their price kept falling like this and their payout ratio was at 80 to 90%. That to me would be much more indicative of potential dividend cut.
We've
Let's
learned
move.
our lessons from those in the past.
They have. It's good to see. Let's move to that history. Yeah, they're almost a dividend king here. Their 5-year average dividend growth rate is 4.39%. Never the highest with the dividend growth rate. I'm not expecting them to light some new record here of a 15% increase. I'm expecting low to mid single digits here as the company continues to work through some of these headwinds. But hey, we'll take it, especially when you move into that bonus metric of the dividend yield. And Lanny, what is that dividend yield?
Guys, that dividend yield is a blistering. It's a hot, high flying, almost 5% dealing 4.5% dividend yield for Leggett and Platt.
We round it to single, no decimal places. Yeah, that gets you up to 5%, doesn't it, Lanny?
Yeah.
Yeah, we'll go with that. All right, so to summarize here, we'll get in Platt. 13.22 PE ratio, payout ratio 59.5%. Almost dividend king here. Increased the dividend with a 5-year dividend growth rate of 4.39% and a 4.5% dividend yield.
Bert, I love it, man. I mean, again, we both have it on our dividend stock watch list. But I know going into this third dividend stock, I know you guys have been buying this over the course of 2022. I've been buying shares of this stock throughout the year as well for my wife's dividend stock portfolio. Bert, who is this consumer goods giant?
Unilever, ticker symbol UL. I mean, yeah, we talk about the brands all the time here. We'll put up an image that, Unilever puts on their website that shows all the big brands. You can find them in every household, every kitchen, every bathroom. You know the drill. That's why we love consumer staples here, because they're recession proof in the sense of you always need their products, you always need to stay clean, you always need to eat, you always need to drink, all the good things that Unilever has there for you. Now, their price has fallen off a cliff right now, obviously because of everything that's going on with Europe and the disruptions to the supply chains there and the prices and what inflation may be hitting some of the European countries. It's not great, obviously, for more than just what's going on with the Unilever stock price, but year to date, they're down 15.5%. And yeah, last week it looks like they entered over $50 per share and they ended at 45.68.
Wow. I mean, talk about a mighty company that has fallen. Bert said it the best. I mean, with everything going on, obviously stocks are being impacted by the battle that's happening right now. But again, this is where you need to still look at the opportunities as they come to you. And this could be a great dividend stock buying opportunity. So Bert, I know analysts are projecting about a $2.85 in earnings. So what's that first beautiful dividend stock metric look like?
Yep, their close price was 45.68. Divide that by the 285. That gives you a PE ratio of 16.02, which for Unilever is pretty low compared to their historical mark and definitely compared to Procter & Gamble.
Pretty close to like a J&J PE ratio. So it's no wonder why you've been buying them, of course, every week for the better part of the last year. But let's get into that second dividend stock metric, the dividend payout ratio. A little higher here. They're actually, they pay about $2 to $2.05.6. I mean, it all depends on the exchange rate that's being used. But they pay out about 69% of their earnings. So still some safety, obviously above the 60% threshold. And that's always been a con for a lot of these legacy consumer goods companies.
Yep. Yeah. So, I mean, it's not that far above the 60% threshold that we use. And to Lanny's point, a lot of the legacy consumer staple companies live in this type of a payout ratio range. So I'm not overly concerned at the moment. They have a long-term history of increasing their dividends. Always hard to peg just how many years in a row Unilever has increased its dividend because of the exchange rate. I can just tell you, if you blow out the dividend chart over time, you see the dividend chart trending upwards. That's what we want to see. And that's good enough for us here to show that the company has a long-term focus on growing that dividend. And their 5-year average dividend growth rate is just over 7% as well.
I love it. I love it. Again, 3 solid dividend stocks. Dividend yield for Unilever at 4.37% too right now to boot. Over 4%, just like Leggett and Platt. I mean, come on. 2 dividend stocks on Bert's watch list. One, 4.5 with Leggett, and then 1 at 4.37% with Unilever. Bert's going for the goat. He's going for the jugular here.
Heck, even Intel with a yield over 3%. I mean, so here I'll quickly summarize here on the three companies. I'm just going to rapid fire through the metrics. Intel, PE ratio 13.57, payout ratio 41%, 5-year dividend growth rate just under 6%. With they've been increasing their dividend for what, 7-8ish years in a row now, Lanny, and their yield is 3%. Leggett Platt, PE 13.22, 59% payout ratio. Almost dividend king, 5-year dividend growth rate 4.39%, yield 4.5%. Unilever, last but not least, 1602 PE ratio, 69% payout ratio, 5-year DGR of 7.18%, and that history of increasing their dividend in the long run with a 4.37% yield. Whew.
Wow, that's a lot of information. So, Bert, what dividend stock is number one on your radar out of these three undervalued stocks right now?
I mean, honestly, I'm just liking all three. I think I can easily foresee a scenario where this week I'm at least picking up, let me see. I could easily see 5 shares of each one of these three in this week. It's not, I mean, all prices are looking great. That's not that much money to add 5 shares of each at a minimum. So, hey, I like all three. I don't have a 1, 2, or 3. They're all pretty equal in my mind right now.
With Intel at 48-ish, at Unilever at 45, 46-ish, and then, Leggett at around 38, they're all around similar price points. So yep. I can really see why you are like, oh yeah, 5 shares of all of them are pretty similar.
Yeah, there's not one where I'm going to jump in and say 25 of this one, 5 here, 10. Let's just get 5 of each. That's going to be my goal, and that's what I'm going to shoot for this week. And if I leave the week achieving that, along with my weekly J&J purchases, I'm going to be pretty happy there because that will be about $1,000 in the market.
Yeah, it's really solid, actually. I'm just doing the math in my head. Yeah, you'll be about $1,000 in with the J&J, Johnson & Johnson dividend stock purchases. I love it. I love it. So, guys, what do you think about these 3 stocks? Do you like Unilever as your number one? Are you buying Intel with their stock price plummeting? Or are you jumping in with the no name? Not many people talk about it. Leggett Platt, dividend king over here.
Yep. And if you don't like these 3 companies, you prefer Lanny's, or you have your own stocks you're watching, let us know in that comment section below. If you haven't already, subscribe to the channel. Give us that thumbs up. We appreciate the support. Lanny, you want to send everybody out of here?
That was Bert, the Hurt, and Lanny from the Dividend Diplomats. Over and out.